Thanks, Susan. Hi, everyone. So I'm Alex Lloyd, Director in the Corporate Finance team at Burgess Salmon. But it's not just me. Today we've got it's a buy one, get one free offer today. You've got Adam Barron from BDO, and we thought it would be useful to have both the legal and the financial perspective on how to raise equity. So that's what we're talking about. It's equity fundraisings, and the idea is to try and leave, we haven't got too long, but the idea is to try and leave you with some practical takeaways. So as Susan said, please use the Q&A, because if we can make it a little bit interactive, it just makes it a better event for everyone. So we're both really glad to be part of Bristol Tech Festival. If you look at the lineup, it looks great. So we're chuffed to be playing a little tiny role in that. And I'll hand over to Adam in a second, but before I do, just a bit of a shameless plug, because we've been at Burgess Salmon, we've been recalibrating the way we work for and look after high growth tech businesses. And we launched last week a product called B-Scale, which is a suite of automated documents. Some of those are for an early stage fundraising. So there's a subscription and shareholders agreement and articles, for example. And then there's a suite of day-to-day documents as well: employment contract, website terms, privacy terms, an NDA, IP assignment, which are free of charge and no strings attached and accessible through our website. So that's what B-Scale is. And it's part of a sort of wider recalibration, as I said, on our part, about investing in early stage high growth tech businesses with a view to building relationships with them. But enough about that. So I'll shut up about that, but please check out the website. And now it's over to Adam to kick us off.
Thanks, Alex. Just to give a little bit of background on me, no shameless plug, but I will tell you what me and my team do. So I'm part of the growth advisory offering at BDO, and we help companies to prepare for and secure funding. That's usually kind of like a pre-Series A, Series A, and Series B round size. What we usually do, and this is kind of our USP, is what we say is we add an investor lens onto your raise. So what that means is we look at all the preparation that you need to do to ensure that when you go out to investors, that process is smooth, that the questions you get from investors are the right types of questions, and that you kind of save management bandwidth time, so that when you are going through a process, you can still focus on your business. So the first thing I want to talk about is kind of how you approach those investors. As you can see from the pretty slides that you can probably tell that I didn't put together myself. Someone helped me make them look a little bit nicer than I would have done personally. But raising funds consists of a number of things. However good your business is, you still need to present it in the right way. The thing is that presenting your business and putting everything together does take a lot of management time. So you need to make sure that everything you do is efficient as possible. And in that, different funds have different mandates they look for. When I say mandate, it is how they raise their funds. So each fund that you go to would have raised money from either pension funds or high net worth, or however they've raised their funds. And the way that they've run that is that they've raised that money as they've turned around to those people, those corporations, and said, this is how we're going to invest. We will only invest in companies that are this size, or in this sector, or at this check size. So when you do go out to them, you need to understand that, because they not only they won't change their mind, but they actually can't change their mind, because then they'll be in breach of the reason that they've raised that fund. But what a lot of them might do is they might soak up your time, because you might be a little bit too early for them. And some of you might have heard this before, where they turn around and say, yeah, well, it's really great when you get to this size, oh, we might be able to go a little bit earlier. Oh, some of our partners might be able to invest personally. And whilst that might be true as a 1 in 1,000, a lot of funders do spend a lot of time talking to management and selling to them. So when it is the right time, you feel like that's the right fund for you. But while you're raising a Series A, Series B, as I said at the beginning, you really want to be able to focus on the building the company at the same time, or the day-to-day run of the company at the same time. So conversations with investors that aren't relevant for this exact point in the business's timeline aren't really using your time most efficiently. And the other reason I say that is that their funds can actually be large organizations. They do they do a great job at marketing themselves. But as an example, one of the funds that we know are only a fund of 4 investors, and they see 4,000 opportunities a year. So if you take into account they've got to sift through all those opportunities, manage the actual investments, raise their own funds, it does them very little time to look at each opportunity. So if you send something to them that isn't presented in the right way and doesn't look like, as sad as it sounds, in the first 10 seconds of looking at your deck or your teaser, that it might be right for their fund, they will not look any further. There are ways that you can get them to look a little bit closer at it, and that is usually through warm introductions. And again, it is difficult because it makes it sound like kind of like a closed club. But the truth is that a lot of people in this ecosystem that we're in are friendly and willing to make those introductions for you. So the helpful tip, I guess, is to not to be shy and ask for those warm intros. If you don't have people that have warm intros to funds, again, don't worry. A lot of these investors are on sell mode. They talk a lot on LinkedIn, they talk a lot on Twitter, so follow them on those platforms. If not, go to events where you think they might be at. Even if they're not there, you'll meet other people who are in the same stage as you, or might know those people and can eventually make those introductions. So it is really important to build out your network to help you get introductions to investors. So I guess the summary of this slide is just to make sure that you're prepared. Okay, so one of those documents that you need to prepare, and it is probably the most obvious one, is the deck. There are a few points here that I'm sure that someone will circulate afterwards, but you really need to keep in mind that when you're putting the deck together. And what you need to think about when you're looking through these points is everyone as another hurdle. So it kind of tells the story of how an investor wants to view an opportunity. So if you look through them one by one, the first thing the investors want to do is they want to see that there's enough interest in the sector, that the market is big enough, that it can get the investors the return that they need to achieve, that they've promised their investors they'll get. And that also equates to the amount of risk that they need to take. So for example, a pre-revenue business that an investor is looking at, they will want to aim to get at least 10 times their investment. If they're looking to make, say, a £1 million investment into you, they're hoping that it's a big enough to achieve kind of what I call them as unicorn hunters. They're looking for a market that's 100 million at least in size. Once an investor is happy that the market is big enough, they need to be convinced that the right management team is there to deliver a plan and capture enough of that market. So who the management team are really important. You don't need to have been there, done that before, but you do need to project a relevant background to be able to convince investors that you're the right management team to take advantage of that market. So once you've got the market and you've got the management team ticks in the investors' minds, you also need to get them convinced that the market has a problem that needs solving. So there could be a massive market, you could be the right management team, but if there isn't a problem, people won't be looking for a solution and therefore won't be looking to buy a new solution. And then is the solution that you're presenting the right solution? So even if you think about, I've got the best solution for this problem, you need to be convinced that people buy it. Is there an 80-20 issue that you've built something incredible, but because you've built it so perfectly, it's going to cost a little bit more. And the potential customers of your solution are going to turn around and say, well, what I've already got does the job. I've been using them for 5, 10 years, however long it is. What this new solution provides doesn't actually give me too much more, and it's going to cost more. It is better, but do I need to switch? Do I need to pay more to do that? And a way to convince investors that the answer is yes, and customers will buy your product, is investors will use the phrase they need to see product market fit, which means effectively revenue, customers, and that will give them more confidence that that 80-20 rule doesn't really apply. It will give them confidence that there is a problem, that you do have a solution and it is the right solution. And then use of funds is also really important, because a lot of investors get decks and they get models and they say, we need 5 million, we need 10 million, we need 15 million. But what they need to know is the amount of funding that they're giving you will have a positive effect on the business. They want to, and it all links back to management as well, they want to make sure that the management team will deploy the investment that they are giving the company, and it will have a positive effect on the performance of the business. They're not giving the management team too much that it will be wasted. The next thing that investors will want to see, and it's something that isn't always prepared that well by management, because it's not really in their skill set, is the model. Everyone can produce a model that shows what a hockey stick is. It is effectively, we're doing okay now, we're going to have a little dip while we're building product, but you know what, we're going to be the next Facebook, and it's just going to tick all the way up, and it's going to look like a hockey stick or a Nike swoosh, or whatever you have in your mind. But everyone can make their numbers and forecasts look that exciting. But there are a number of things you can do to increase the credibility of your numbers, and by increasing the credibility of the numbers, you're also increasing management's credibility, and therefore investors' confidence in management's ability to carry out that business plan. And to do that, you need to make sure that each assumption has a reason. Anything that you can do to give more certainty to that reason, which is data points, benchmarking, will just give more credibility to the business plan and therefore to management. Of course, it's good to say this is an industry standard. Investors that are investing in your business will know if something seems too high or too low according to an investment they've got in their portfolio, or just what the market says. But even better, and it goes back to the product market fit point, is if you have done it before and you can say, this is how much we know that our customers will pay. We've actually tried to charge them more and it didn't work. Or we charged them less and we increased it and there was no churn. All those types of things will only do more for the credibility of your model. There's no harm in pivoting to what you've done before, but investors will want to know, if it didn't work before, why is it going to work now? So if you say, we're going to do more of what we were doing before, we just need a bit more investment, an investor will say, well, how much difference is that investment going to make if it hasn't been working previously? So there are a number of things that can give investors confidence in what they're seeing. As I mentioned earlier, they do see a lot of opportunities. It is really key to know that a good model doesn't make an uninvestable opportunity investable. So don't just, without any reason, go out, build this incredible model, make it do all these incredible things, and say, look, I've got this amazing model, Mr. or Mrs. Investor, please reinvest in me. Because if the underlying business, all the points that I brought out in the deck slide a few slides ago, doesn't stack up, the investor won't just say, look, the model's great, of course I'll fund. But what it does do is it makes a fundable opportunity even more investable. Because what an investor will do is they'll look through your model, and they'll sensitize it because, as I said before, anyone can make a hockey stick, but investors will say, okay, what happens if we scale back the headcount, or the revenue does take a bit more time to come through? Am I still going to get those returns that I need? And if it's a clunky model and they can't do that dynamic sensitizing, they will put it down and look at the next shiny thing. Again, seeing lots of opportunities, you need to make sure that your opportunity stands out. The more prepared you are, the easier it is for an investor, the better. So I think had about 10 minutes. I think I've used my 10 minutes. I'm sure I did everything at quite high level, so you probably have a few questions. I don't know if Alex, if any questions have popped through.
Yeah, there's a few. Let's take a minute just to give you a grilling, Adam. So the first one, and this is a sort of a how long is a piece of string question.
Mm-hmm.
But assuming we've done all the right things, and as you said, you've spoken to the right investors and you're not wasting time with the wrong ones, how much management time are we talking to get to the point where you're starting to document this thing legally? So how long are we talking from having the idea to raise funds, getting to a proper model, full deck, having had the conversations, and you're there with the term sheet?
So you're right. How long is a piece of string? It depends how good your model and deck is to start with. If you are going to use an advisor, there'll be a few iterations. What we always say is it needs to be management's plan. So what could speed it up, but I really don't recommend, is giving it to someone else and saying, can you make the model and the plan for me? It's really got to be in management's words. So I think with someone to bounce ideas off the deck and the model could take 3 to 4 weeks. Then going out to investors, another thing we like to do is the first call that we have, that any management team have with investors, is a half an hour call to make sure that the culture is right between the investor and the management team. And then from there, have management presentations, which are more an hour and a half. So it does depend. I think, as I said earlier, finding the right investor to go to really helps. There's a project that we worked on recently. We only went to 8 investors because we wanted to make sure that management had enough time to focus on their own business. But all those 8 investors ended up taking management meetings because we did a lot of work early on to decide which investors would really like the opportunity. And it's really not a shameless plug, but that is sometimes where an informed advisor can really help, because a lot of advisors, that is a lot of their job, is spending a lot of time with these investors to understand what they want to invest in next. So the opportunity that I'm talking about is a manufacturing opportunity. And there are a number of funds that don't want to touch manufacturing at the moment, but there are also a number of funds that have a gap in their portfolio whereby they want to invest in manufacturing companies. And they said to us, when you've got something that's in the manufacturing sector or vertical, please show it to us. We knew that they'd be excited to see it. And so that sped things up quite rapidly. So I'd say that process of management meetings is about a month, and that is the most time intensive on a management team. The next bit is in exclusivity, you have all the due diligence process, and that is just something that you need to work around, making sure that the timings don't overlap. If you need the money or want the money faster, you might have to do a few overlapping due diligence processes. So you might have questions from the financial, legal, commercial due diligence offerings all at the same time. But if you're happy to extend that, you can spread that out, giving management a bit more time to spread their time.
Thanks, Adam. I guess the takeaway is it's a serious thing to do and it takes a serious amount of time, so be ready for it. Next question was about total addressable market size. And one of the questions that came through is about, you might well have a product that sits across 2 markets or 3 markets. So the question was, how do you explain that? And the example was ed tech and gamification, but I think you just take it as any 2 markets.
Yeah. So just to be as precise as possible, if you are in the edtech market, it's not, your total addressable market isn't edtech. Is it the consumers? If it's the consumers, is it an age range of consumer you're marketing to? If it's schools, is it primary schools or secondary schools? Is it in the UK? Is it in Europe? Is it in the US? What I would always show is what the initial addressable market is, and then what the next addressable market could be. So if you are first going to market to UK primary schools, that's your initial addressable market. So you can either show it as like what's it called, like a tree, to show the total addressable market at the moment with the initial addressable market at the top. But you could do a Venn diagram to show how much they meet in the middle. But you, as I've said a few times, what you really want to give is investors confidence that you are a credible management team. So don't go out and say it's gamification. The gamification market is 500 billion, and it's edtech, and the education market is also 500 billion. So both of those together is our addressable market. As long as you've thought about it, it makes sense. But don't underplay it, don't overplay it. Just make it obvious that you've thought about it.
Yeah, thanks, Adam. It's great. Well, this is I like this interactive bit. So I'm going to ask one more. I know we're sort of running short on time, but it's a quick one. We've talked about what the company needs to do a lot, but what about when you're looking at these investors? Could you talk a little bit about value add you might get from a particular investor and the kinds of things they offer in terms of access to networks, whatever else they might say when you're making your selection of which investor to go with?
Yeah, of course. I mean, one thing that I would always suggest is getting references from existing investors' portfolio companies, because investors will always say we're value add, because investors, when they like something, are in sell mode. But there are two things you really want to know. One, how much value add they are, but two, what do they do when it's not going right? And I think that is a more important question you need to ask of investors, because there are going to be bumps in the road. Every entrepreneur knows that it isn't plain sailing. It is tough. So you need a supportive investor. There are investors that will say we're more passive. Things that you can expect from some investors are links to their portfolio companies. They have meetups. They have, as simple as it sounds, WhatsApp groups where you can talk to other investors in their portfolio. Some investors will want to invest in you because they can see an immediate synergy with their existing portfolio. So, for example, if you are a tech solution for the hospitality sector and they have a few hospitality investments in their portfolio, that might be an instant plug-in to those hospitality clients, which will give everyone a revenue boost. What we see a lot of in slightly later stage companies is the investors access to a wider network where they can bring a non-exec director or an interim FD or someone into the company. So being really honest with an investor and saying, this is where our gap is, can you help us plug it? Because one of the things we're looking to raise money for is to bolster the management team. These are our gaps. Who do you think is the right person to help? So different types of investors, but grill them as to what do they do when it goes wrong and how much value add can they be, but make them be specific into where can they help plug the gaps in your offering.
Great, thanks, Adam. Susan, could you pass the ball to me now, please? Great, I think I've got control of the slides now. So I'm going to talk about three things. So I'm starting off, I should have started off with the positive, but I'm starting off with the negative. A couple of common pitfalls. They're not really just pitfalls, considerations, let's call them. A little bit on preparation, and that's mainly around what you can expect from due diligence. And then I was going to look at some key terms. There's not a huge amount of time, so I might not get through all the slides. I'll try and concentrate on answering any questions that pop up. Because like I said, it's probably better to answer specific things if we can. So common pitfalls, first of all. Some of these are a little bit conceptual. That's deliberate. So let's start with that circle which says expectations in it. What I was getting at is you've got a group of founders and they've got a company that's their baby. and then they're being thrust into often an alien process of raising capital for the first time. And there's this sense there can be this sense of losing control, and you're going to be presented with this set of documents that's asking you to take on liabilities. It might even be saying, there are circumstances where you can lose some of your equity. And often if people get blindsided by that, if they're not going in with their eyes open, it can set things off on the wrong footing. I suppose the takeaway is there's a risk involved. There's a risk for the investor. They're investing in an early stage business. And there is a risk through the terms of the documentation for the founders. And that's a cost of raising capital. So point is, go in with your eyes open. Second conceptual point in that top circle is it's also quite easy to fall into a kind of us versus them mentality. You're presented with a load of documents, and those documents are by their nature designed to protect the investor in lots of ways. And so you can feel as if it's a combative environment, and it shouldn't be, because it's all about building a relationship. This is on the way in. This should be a positive experience. And you'll also see as we go through the terms later on that there's often alignment of interest as between the investor and the founders, and it's not about us versus them quite often. I'm not saying you shouldn't negotiate hard, of course, but just want to make sure you're approaching things with the right mindset. Heads of terms is the next one. And the reason I put it in really is because I've seen very recently on two very similar transactions, people raising money from VCs around the same sort of amount. One management team or one set of founders spent a lot of time on the heads of terms, sought to clarify, sought to negotiate, and ended up with a much more efficient process for a start, because everyone was clear about what the document should say from the off. Another management team spending less time on the heads of terms, didn't fully understand all of the terms that were in it, and then were presented with a set of really standard form investor-friendly documents from which we had to row back. And the outcomes for those management teams were quite starkly different. So if you can, and if there's competitive tension, and if there's time, sometimes spending a bit more time on the heads of terms can front load the process, make it easier, and give you a better outcome. Next one's skeletons in the closet. We're going to talk about this on the next slide, so I won't dwell on it. But if there's something that hasn't come out early in the process that you know about that may well be a problem, we want to address that skeleton early, and you may be able to present it in such a way and to explain why the risk isn't as big as the investor might think it is, and dress it up appropriately to mean that it doesn't become blown out of proportion. If you've got an issue that arises late in the process, it can derail things and cause lots of problems. Next one, EIS and SEIS. So if your investors, they may well be reliant on the tax advantages that come with those schemes. So that's the enterprise investment scheme and the seed enterprise investment scheme. And so if you're going to seek advance assurance from HMRC, you want to do it early. And bear in mind that, yes, sometimes it can be straightforward, but depending on the nature of your business and whether it's going to qualify for those, the legislation is actually quite complicated, and it's not always as easy as you might think it is. So SEIS and EIS, consider it early. Last one's just a runway. If you need to raise this money quickly, give yourself enough time. Don't leave it to the very last minute where you're running out of money and you're desperate to get the cash in, and the whole process becomes an extreme rush. End up with a worse deal in the end. So those are some of the common pitfalls. Next is about DD really, and how you prepare the company on the legal side, at least for the due diligence that people are going to be doing on you. And it depends, all of this depends really on the nature of the investor and the amount you're looking to raise as to how detailed their analysis is going to be and how thorough the DD. But in general, you're going to get a long questionnaire sent to you. You're going to get a few. You're going to get a financial one, you might get a commercial one, you might get a technical one, and you're going to get a legal one. And you're going to be responding to those questions in narrative form. And you're also going to be likely uploading documents in response to those questions to an online data room. The first circle on there is really outside of that diligence process really, but existing shareholders. So you've got to think about your existing cap table. Are there people in there that can block the fundraising? And do they have veto rights for a start? They're likely to have preemption rights, which means that they can partake in any new issue of shares. Are they going to activate those? Have you spoken to them about it? the likelihood is you won't go through that formal preemption process. Rather, you'll agree with your existing shareholders who's going to take what in the next round, agree that with the incoming investor, and have it outside of the formal process mandated in the documents. But you've got to have those conversations. The next lot, just various areas of legal DD that might pop up. Won't dwell on any of these, we'll just quickly whip through. So data protection. If yours is a data-heavy business, if you're handling sensitive data, clearly it's going to be an area of focus. A hell of a lot of early-stage businesses don't have their policies quite right. And to a degree, that'll be accepted and understood that you may not have absolutely nailed every piece of a very fast-moving, regulatory area, but you should have a decent set of data protection policies, and you should be cognizant of what you need to do. IP and brand, obvious again, I suppose, but if these are tech businesses, IP is likely to be important. Who owns that IP? Does the company own it? Are you sure? Is it potentially vested in the employees or the founders rather than the company itself? That'll be important. If you need to license in technology, how robust are those licensing arrangements? Because those are going to be an area of focus. All of this stuff is about unearthing that skeleton early and then being able to present it in such a way, or remedy it, or present it in such a way that the risk is minimized. HR and incentives. It may well be that key employees need new service contracts. So what state are your employment contracts in, the basic level? You may well have EMI option schemes either in place already or to be put in place as part of the transaction. So you'll need to understand those options and how they impact the cap table, who's going to be diluted by any new option scheme. Key contracts, another obvious thing, if you've got a key customer or key supplier, how robust is that contract? Can it be terminated easily? All the obvious stuff that you might think about contracts, but be aware and be able to explain how you contract legally. Real estate is obvious one, I suppose, but do you have the arrangements in place that allow you to scale? What you can do with your office, does it match what you plan to do in your business plan? Those are just some of the areas that likely be touched on as part of your diligence. Next, we're going to nip on to some of the key terms. The reason I put these slides in is really to make sure that you're sort of cognizant on the way in of some of the key areas of liability and some of the obligations that are going to be imposed upon founders, and sort of the concepts that underlie them as well. So warranties are the obvious one. But what is a warranty? A warranty is really a contractual promise. So at a basic level, let's think of it as we warrant that the company's not involved in any litigation. And if that's untrue and you haven't disclosed it, you haven't told the investor that there is a piece of litigation ongoing, there's a chance of a claim. Before we get into the sort of types of the warranties and the takeaways from it, what are the principles at play here in this scenario? So the last thing that the investor wants to do is sue the very people that it needs to deliver value for it. So that's why I've said on that slide, recovery from management is a nuclear option, because they're crashing the value in their investment by suing the people that they need to deliver that value. So what it's about, what the investor does want you to do, though, is to really think about the warranties that you're giving, to have enough jeopardy, enough on the line to make sure that your minds are focused, so that the disclosure process is full and adequate, and that the investor can verify their investment rationale and the due diligence that they've done. You'll be giving various types of warranty. Fundamental warranties, just things like, I have capacity to enter into the agreement. The shares that are held by me as a founder I have title to those shares. Those are the fundamental ones. Shouldn't really be an issue, because if you can't confirm those things, then there's something seriously wrong. Then you might get some operational or business warranties, just about how the business runs. You own the IP. There's no litigation, et cetera, et cetera. And then you have another set, which are the investment warranties. And these are about, we've prepared the business plan on reasonable assumptions and in good faith and diligently. We've looked at the DD reports that have been prepared, and we don't materially disagree with the facts that are in there. And then you'll also be asked to fill out management questionnaire, which will ask about your other business interests, about whether you've been bankrupt, about your financial status, etc. And you'll be asked to warrant the content of those questionnaires as well. Takeaways, so the practical things to take away. the way you prevent any warranty claim is to disclose against those warranties. So if something's untrue, you say it, and you say it with enough detail and specifically enough, and with reference to a document perhaps, such that you qualify that warranty. And there'll be a standard of disclosure you've got to meet in the investment document. So that process is a way of protecting management, and it's a way of uncovering information for the investor. So that's crucial that's done properly, fully. Second takeaway, these warranties are about verifying the situation as it is right now. So they're not about saying what will come true in the future, what's going to happen later. It's about, we're investing now, what's the state of the company at this moment, looking backwards, which is why that bullet says they shouldn't be forward-looking. Going back to that business plan warranty, so you're warranting the business plan. You're saying we've prepared this diligently. The assumptions that underlie it are reasonable. We believe it to be, a decent business plan. What you're not saying, what you shouldn't be saying, is this thing's going to come true. So it can't be, it's about facts. It's not about forecasts. You can't say that the forecasts are going to be correct. You may say that the assumptions underlying them are reasonable, but that's as far as you go. Knowledge qualification. You remember we said earlier it's about focusing management's minds, these warranties in the investment document. So which means it's quite a good argument for you to say on lots of these, or maybe all of these, that we warrant so far as we are aware. So it's not an absolute warranty necessarily. You're warranting your own knowledge, which clearly allows you to feel more comfortable about giving the warranty. As long as you've gone through the process and thought about it in detail and talked to the relevant people, you can have confidence in giving the warranty. Financial limits, usually set at somewhere between 1 times and 2 times salary. It's about that jeopardy, but it shouldn't be crippling. Time limits between 1 and 2 years, but sometimes an investor will look to set the time limit so they get a full audit sign, full accountancy sign. So that's warranties. Next one, leaver provisions. So these are, if a founder or a manager leaves the business, these provisions might well be there, and they might well kick in to compel you to sell your shares. And the manner of the departure, the reason for you leaving, governs the price that will be payable for the shares. Again, we'll come back to the takeaways in a minute. Let's go for the reasons for these provisions in the first place. So the investors backing the founders, backing the management team to deliver that. And Adam was talking about how important the management team is in their investment decision. So they need you to stick around. They need you to be incentivized to stay and disincentivized from leaving, because you put forward your business plan, your model. You've got to be there to deliver it. Also, if somebody leaves, and this is that bit where we're saying, management or founders and the investor are in the same boat. So if you're the person who's remaining as part of the management team, and somebody leaves the business, you want these provisions to apply, because you want that equity sometimes to be acquired so that you can recycle it and incentivize someone else who's going to come in. You also want to disincentivize someone from leaving the business and holding on to value. So this is another place where you're aligned. So you've got to think about these things with 2 hats on, both if you're the leaver and also if you're the remaining founder or manager. I'm going to skip on to the next slide quickly just to give some examples of the provisions. And clearly there's all sorts of variations, right? This is just a basic set to give you a feel for the kind of the kind of clauses you might see. So the top row, investor-friendly one. So you're a good leaver if you die or if you're critically ill, which sounds really harsh. And it's only in those circumstances, and this is, remember, this is an investor-friendly formulation, but it's not one that it is one that you might see, especially in the first draft. And it says, if you're a good leaver, you get fair market value for your shares. And bad leaver is this enormous category which captures anything else, in which case you get the lower of issue price, the nominal. So you really lose all value in your shares. And in that investor-friendly scenario, this could encompass all shares held by the founders. So there's no shares that sit outside of the regime and the sacrosanct. The other way around might be to have a founder-friendly formulation, where instead of it being a defined good leaver category and everything else being bad, you might define the bad leaver category as a very narrow band of significant misbehavior, fraud, summary dismissal under your employment contract. So that's dismissal where you don't have to give notice, or breach of restrictive covenant. That's, non-competes, non-poach employees, those sorts of things. And in those narrow band of situations, you lose all the value in your equity. And everything else is good, in which case you get fair market value. You might also, if it were a very friendly formulation, you might also say that certain shares just aren't capable of being transferred. There's no compulsory transfer over a sacrosanct slice of your equity. And then you get a whole range of clauses in between. And one of the sort of obvious ways of bridging a gap between the investor's view and the founder's view is to introduce another category of intermediate lever. So in this, the final scenario at the bottom, you've got a fairly broad definition of what a good lever is. It's more than just dying or being critically ill. You've got your narrow band of bad lever definitions, which give rise to this loss of all value. And then in the middle, you have a intermediate category. And in that category is everything other than good and bad. And over time, shares vest. And for the vested shares, if you leave at a time when you've vested 50%, you're going to get fair market value for the 50% that are vested. And you lose the value in the other 50%. I just thought it was useful just to give you a flavor of what those provisions are, because they're very often some of the most contentious and the ones that get people's emotions going the most, because it's about taking equity in the company that you've built. Takeaways are basically, as we talked about just now, should some of the shares be sacrosanct altogether and sit outside of the whole regime? There's a big difference between you're good if you're not bad, and you've got that narrow category of bad defined and everything else is good, versus you're bad if you're not good and it's the good category that's narrow. Can you use that intermediate lever or that early lever concept to bridge a gap? And then the other thing to think about is the triggers are often linked to what's in your employment contract. So that summary dismissal trigger, for example, if you're summarily dismissed under your employment contract, it might lead to you being a bad lever and losing your equity. So you need to be sure that the list of reasons for summary dismissal in the employment contract is narrow enough. And then individual circumstances. Is there someone in the business coming up to retirement age that needs to be dealt with specifically in their personal circumstances to that? So those are lever provisions. I'm not sure we're going to get through all of these items, so I do want us to try and stop for some questions if I can. Although I know that there's not much in the way of questions about the legal stuff, so if anyone wants to ask me something, please go for it. There's an extra couple of questions for Adam, so I'm getting away lightly at the minute. Let's move on to restrictive covenants then. So this is your non-compete, your non-poach of employees, non-poach of customer type provisions. And the same principles apply here really. Investors backing the management team. Clearly the investor doesn't want any of the founders or the managers to go off and start a competing business, or to leave and then to take employees from the business that they've invested in. And it's the same thing. It's the situation where you're in the same boat as the investor. If you're the remaining founder, of course, you don't want somebody going off and competing. So you're wearing two hats again here. The couple of takeaways. Worth saying this because I've seen in quite a few documents of late that you've got the restrictive covenants running for an inordinate period of time. So be careful if it says something like you're restricted from competing or from poaching employees for a period of 24 or 12 months from the date that you cease to hold shares. So these are private companies with illiquid shares. It's not guaranteed that your shares will be acquired when you leave. So you could end up being locked out of the market under the non-compete ad infinitum, because you might be holding a small shareholding, which there's no exit on the horizon. There's no way of you realizing those shares. So the takeaway is have your non-competes run from the date that you cease to be employed or involved in the business, not the date that you cease to hold shares in the business. Next 2 points are sort of obvious ones, I suppose, but how do they define competing business? Is it actually, is the definition of restricted business actually narrow enough, or does it try and lock you out of a wider market than is appropriate? And then enforceability. If you try and impose restrictive covenants that are too long, usually it's somewhere between 12 and 24 months. It can be longer in these documents, remember, than in the service agreement. So this is why you probably wouldn't see a 24-month restrictive covenant in the employment contract, but you might see it in your investment document. But if you go too far, too long, there are circumstances when you can extend it out, but you might end up having a set of restricted covenants that aren't enforceable. That's the other takeaway on that one. I think, given that there's not a huge number of questions that I can see, oh, hang on, there are some questions coming in, so maybe I'll address them now while we're doing it. Okay, one question's come in already. How common is having a concept of sacrosanct shares? Well, it is relatively common. So I've done, in the last few months, I've done 3 VC investments, all from quite major UK VCs. And in each of those 3, we did end up with a portion of shares that sat completely outside of the Viva regime altogether. It depends on the nature of the business to a degree. So if you've got a founder who's got a very large stake in the business, that founder might well say, well, I don't want all of my equity to be on the line. I've earned some of that equity up until this point, and I want it to be sacrosanct. I created that value sat there, and I want to protect it. So the concept is not unusual in my experience, and I think you can argue for it. Clearly there's a negotiation to be had, and it's not always the case. Okay, quickly moving on to liquidation preferences to finish it off. Oh, Adam, I see you popped up. Have you got a question to ask?
No, I was just here just in case you were asking me a question.
Yeah, all right. I'll quickly nip through this liquidation preference thing in 5 minutes, and then I think we'll call it a day unless there's other questions popping up. So what is a liquidation preference? So on a liquidation event, and by that we mean any return of capital, really, a sale, winding up, whatever. It's probably easier for these purposes to think of it as a sale. It's easier to get your head around. The investor's going to get it, if it's got a liquidation preference, the investor gets its money back, or a multiple of its money back, depending on what type of liquidation preference it is, before anyone else is paid out. That's the basic premise. If it's a 1 times liquidation preference, the investor gets back an amount equal to its investment. Easy. If it's 2 times, it gets double the money back. And then there's another distinction between a participating and a non-participating liquidation preference. So participating means the investor receives its preference first, and then whatever's left after that, the investor shares pro rata in. That skews the upside returns, and we'll see that on an example in just a second. On a non-participating preference, it means the investor receives its preference amount first, then the founders of the management team get to catch up until they reach parity, and then the remainder split pro rata. So that's a protection that exists in a downside scenario when things have gone wrong, but it doesn't skew the upside. So takeaways really are, depending on what's negotiated, and there may be legitimate reasons for somebody asking for a participating preference, or for asking for a 2 times or 3 times preference, but generally founders are looking for this to be a downside protection only, which means it should be a non-participating 1 times liquidation preference, if possible. So very quick scenario. So in this example, you got founders made initial capital contribution of £100, and they got 100 ordinary shares. Your investor then comes in, and you agree a pre-money valuation of 200,000. So divide 200,000 by 100 existing shares gives you a price of 2,000 per share. And then your investors subscribe for their 100 preferred A shares at £2,000 per share. That gives you the £200,000 subscription price. And those preferred A shares carry a liquidation preference. So this takes you through a couple of examples. You've got a £200,000 sale and a £1 million sale. So remember, the investor put in 200 grand. So the 200k sale is not a good scenario. No one's really made anything from it. So let's go through that downside example first. So if there's no liquidation preference, things get split pro rata. And here, remember, we've got 50-50 shareholders between founders and the investor for ease. So investors taking 100 grand, founders are taking 100 grand. The next 2 examples are where the liquidation preference kicks in. And in this case, because we're talking about not a great outcome, the liquidation preference kicks in to protect the investor's investment and all of that £200,000 goes out to the investor before anyone else sees anything. So in both the next two scenarios, where there's a one times or where there's a participating or non-participating preference, founders end up with nothing and the investors end up with 200 grand. £1 million sale next. So you've got, same again, if there's no liquidation preference, it's pro rata, 50-50, £500,000 each. And then the next example will show you how having a participating preference can skew the upside returns. So you've got £1 million to go around. That first 200,000 goes to your investor under the liquidation preference. And because it's participating, you've then got 800 grand left over, and the investor's going to participate pro rata in that 800,000. So it takes the next 400, giving the investor 600,000 and your founders 400,000. So the upside scenario with a participating preference is skewed in favor of the investor. Your upside scenario with a non-participating preference, you end up back at 50-50. First 200,000 goes to the investor, but then this catch-up right will kick in. The next 200,000 will go to the founders, and that leaves you 600 grand to be split 50-50. So you end up with 500,000 each. So that's just a practical example of how a liquidation preference works. And I think that brings us to a close. So we've got a couple of minutes left. So I think if it's all right with Adam, there's no more questions for me on the Q&A that I can see. So I'll just ask Adam a final question before we go. So, and this is partly for my benefit. So we talked about earlier, you're preparing your business plan and you're preparing your assumptions under the business plan. And I said, when I was talking, that might be asked to warrant that business plan and the assumptions that underlie it. Just wondering what you advise in terms of how much narrative do you put around the assumptions and how detailed does that business plan end up being?
So what we like to do, and it is a little bit more work, but we feel it's worth it, is for every number that's in the business plan, there is an assumption around it. And to make that easy for an investor to digest, we produce a separate PDF document, which is in the form of a table, and which just explains the reasoning for each assumption that's in the business plan, which is in the financial model, which helps for two reasons. One, an investor will be able to read through that document, and when they look at a number and they say, I don't really understand the reason for the gross profit increasing, decreasing, I don't really understand for the increase in headcount from 10 the first year to 30 the next year. If the explanation for that assumption is in a separate document as a companion to your financial model, it will give the investors comfort that there is a strong reason behind the numbers, and in effect that also helps you to warrant your business plan, because it just gives you the security that it has all been thought through. And I think, Alex, something that you said is really true. It isn't if something goes wrong, you'll be on the hook for it. If it has been prepared with thought, in good faith, then that's the most that you can do. So I think putting that little bit more work in makes you more investable, but also protects you on the warrant side.
Thanks, Adam. I think that probably brings us to a close, everybody. So thanks everyone for joining and for listening. I think there's going to be a survey at the end, so if you don't mind filling that in, that would be super. Thanks very much.